How to invest, what index fund should I invest into, should I invest in a stocks and shares ISA or a SIP, are just some of the questions I get asked all the time on YouTube and in my school community. I've been investing for 24 years and I've invested into index funds for the last 6 years. So today I'm going to give you a 5-step plan to start investing in the stock market. And I'm going to take you back to 2019 when I first started investing using Vanguard. But first, I'm going to tell you a personal story of why investing into assets is so important. Invest into assets to build wealth. Over the last 20 odd years, I've met hundreds of people full of regrets, friends and family, but mainly people I've worked with. Contractors in their late 50s or early 60s who earned a fortune working overseas. I remember working in Oman back in 2020. I was stuck over there for about 12 weeks because there were no flights. It was brutal. Anyway, a colleague, 60 years old at the time, told me I could have easily saved £1,000 per month between 40 and 60, but unfortunately he didn't. This situation is normally down to a lack of financial education. If he'd invested that £1,000 every single month in the SP 500, averaging 10% annually, which is in line with historical averages, he would have ended up with £750,000 at the age of 60. That's financial freedom for most people. Over the next few minutes, I'm giving you a 5-step plan you can follow to build wealth using index funds. The same plan I started using in 2019 when I began investing with Vanguard. Step 1, learn what index funds actually are. If you can understand a shopping basket, you can understand index funds. Here's the easiest explanation you'll ever hear. An index fund is not a complicated financial product. It's not gambling and it's definitely not day trading. It's simply one investment containing hundreds or even thousands of companies. Think of it like a shopping basket. Instead of buying Apple, Amazon, Microsoft, Tesla one by one, worrying about what to pick, you buy the entire basket. Here are some examples of popular indexes. The S&P 500, which is the top 500 companies in the US. The FTSE 100, the top 100 companies here in the UK. FTSE All World, made up of large and medium companies around the world. Global All Cap, small, medium, large companies globally. Index funds are passively managed, meaning no fund manager picking winners. No guessing, no extra fees. The fund does not choose companies. It simply follows the index. Why this is powerful? Because historically, buying the whole market beats 95% of professional investors over the long term. One click, decades of growth, minimal fees, automatic diversification. This is why index funds can potentially change your life. If this info resonates, if you want to know how to invest long term, hit subscribe, and using 24 years of real investing experience, I'll do my best to help you step by step. Step 2, how to buy index funds. Buying your first index fund takes less time than boiling the kettle. This is where 90% of people get stuck, but it's actually really simple. Here's the exact process step by step. 1, choose a platform. You can use Vanguard, AJ Bell, Hargreaves Lansdown, Trading 212, etc., etc. What matters when choosing a platform is low fees, easy to use app or website, access to the index funds you want, FSCS protection up to 85,000. This is important as you want as much protection as you can get. 2, pick an account type. For most people in the UK, an ISA is a really good place to start. The 3 main choices are a stocks and shares ISA, tax-free investing, a SIP, pension with massive tax relief, general investment account, GIA, no tax benefits. If you don't know what to pick, pick an ISA. Just my preference for what it's worth. 3, deposit money. 1 tap, bank transfer, simple. 4, search for your index fund. Just type S&P 500, FTSE All World, Global All Cap. All the results pop up. Choose maybe 10 to start with, then start comparing past performance. This is what I done back in 2019 when I first started investing with Vanguard. 5, choose accumulation or distribution. Accumulation is where dividends are reinvested automatically, and this is what I do as I'm at the point where I'm building wealth. Distributing, this means your dividends are paid out to you. This is what you would do when you retire and you want to live off the interest of your investments. Basically, most long-term investors choose accumulation. Income investors later in life use distribution. 6, click buy. Start with £10, £50, £100, £500, whatever you can afford. Fractionalised shares means you don't need full share prices, and you're in. You're officially an investor. As you can probably guess, I'm not a financial advisor, and this isn't me giving out financial advice. I'm not an expert, not even close, but I'm sick of seeing people I care about struggling financially, and my intention is to help as many people as possible with my experience. Step 3, what index funds should you buy? You don't need 10 funds, you need 1. And consistency. This again is my opinion. Some investors go for 2 or 3 to get even more diversification. Most beginners pick the wrong fund. Here's the cheat sheet. Fund 1, Vanguard S&P 500, tracks the biggest 500 US companies. Really low fee of 0.07%, accumulation and distribution versions available. One of the world's most popular funds. Why it's a brilliant option? America is 65% of the global stock market. Historically strong returns, ideal for set and forget. Fund 2, iShares S&P 500. Same index, same companies, same long-term performance. The brand is the only difference. Think of it like choosing between Coke and Pepsi. You buy whichever has the lowest fee, best tracking, or is available on your platform. Fund 3, the Vanguard FTSE All World. This has 3,600 plus companies, developed and emerging markets, diversified worldwide. It's a great one fund portfolio option. 62% US companies, 16% Europe and 4% UK. Fund 4, Vanguard FTSE Global All Cap. This fund includes large companies, medium companies and small companies, which give you higher growth potential. Why this is powerful, you get exposure to companies before they become giants. More diversification than All World, a favourite for many long-term investors. Slightly higher fee of 0.22%, and this is something that us investors need to really think about. Fund 5, FTSE All World High Dividend. Focuses on companies with strong dividend history. Used for income portfolios, good for future passive income. Pairs well with a global fund. How to choose among these 5? Ask yourself, do I want maximum growth or maximum diversification? S&P 500, probably the most popular fund in the world, and you're getting growth with this option. All World, diversification. Global All Cap, even more diversification. High dividend, income later in life. Here's a little spoiler. You can't really go wrong. They're all pretty similar, to be honest. Step 4, how to find your retirement age, using the 4% rule. Some investors don't like it, but I do, mainly because it's simple and it's a good starting point when you start thinking about retirement. This one calculation can literally tell you the exact year you can retire. The 4% rule is simple. You need 25 times your annual spending to retire forever. If you want 40,000 per year, 40,000 times 25 equals £1 million. If you want 30,000 per year, 30,000 times 25 equals £750,000. That's your target number. How to find your retirement age? This is where your compound interest calculator comes in, which is free on Google. Example 1, £500 per month, a 10% return. This isn't guaranteed, by the way, but it is based on over 100 years of historical data. After 30 years, you end up with over £1 million. Example 2, £1,000 per month, a 10% return. After 20 years, you end up with over £750,000. This tells you exactly when you can retire. Increase your monthly investment, retire earlier. Decrease your costs, retire earlier. Get a better return, retire earlier. Start investing as soon as possible. It's important. This is how the wealthy plan their entire lives. If you want one-to-one support with investing, by the way, to get started so you can invest in the stock market with confidence, type yes below and you can join my investing community on School. Or you can just have a look at the link below in the description. But that comment will help. Step 5, how to retire early using index funds. Early retirement isn't magic, it's maths plus consistency. There are only 5 things you need to do to retire early, and you can start today. 1, spend less than you earn. This is your superpower. Your investment ability comes from your savings rate. 2, invest consistently every single month. Automation equals wealth. Set up £100 monthly, £200 or maybe even £500, depending on what you can afford each month. 3, let compounding do the heavy lifting. Compounding is the 8th wonder of the world. It's important. Your money makes money. Then that money makes money again. And that continues forever. Compound interest is basically interest on top of interest. But there's more to it than that. And if you want to know exactly why compounding is so important, see below for a recent video. 4, increase your monthly contributions over time. Every pay rise equals raise your ISA. Most people inflate their lifestyle. Winners increase their investments. 5, stay invested through everything. Not timing the market, not jumping between funds, not panic selling, just buy, hold, repeat. This is how you retire in your 40s, 50s or early 60s. Summary. Imagine having no boss, no financial stress, no alarm clock, no fear of losing your job, no pressure to work until you're 67 or even later. Imagine waking up one day and realising your investments now earn more money than you do. That life starts with a single step. Buy your first index fund. Today, not tomorrow. So now you know how to pick the right index fund, but there is something you need to invest into before you even start with index funds. See below for a recent video and the best order of investing for 2026.